of you. With continuation of that last video, internal rate of return. Now we move another term as a external rate of return. As a external rate of return. In this external rate of return, in this external rate of return, we calculate at interest rate. We calculate interest rate for a reinvestment purpose. Calculate interest rate for reinvestment purpose. That internal rate of return, in that internal rate of return, it is a rate at which that cash outflow, cash inflow becomes equal, and in that company earn some amount on that investment. Company earn some amount on that investment. So that interest rate we consider as internal rate of return. In this external rate of return, suppose from one project, company get some profit. One project company gets some profit or revenue. That particular amount he invested in another project. At its particular MARR value. And at what rate? At what should be the interest rate? At which that reinvestment should be, at what interest that reinvestment should be get return as early as possible. So that particular interest rate we can consider as a external rate of return. So whatever that reinvested by that company, so that particular interest rate at which that reinvestment amount is get back or return as soon as possible. So that particular interest rate we can consider as a external rate of return. That particular rate of interest we can consider as external rate of return. So for a reinvestment consideration, IRR cannot be used. We use in this case as a external rate of return. So for a period of project period is considered as N. Then at for particular, if you consider for particular amount of period, you have to calculate this external rate of return. That particular amount of period we can consider as a K. Total life of project is a N, capital N. So R here, R suffix K we can consider as a receipt. That notations are same here also. That R represent that revenue or receipts. E represent expenditures, and suffix K here represented for particular period of time K, and these are considered as it is a reinvestment type. We consider this R nothing but a receipt or revenue over the expenses, and E represent expenses. EK here, E suffix K here represent expenses over the revenue or receipts value. So with this usual notation we can consider this external rate of return. So this external rate of return is, if it is greater than or equal to MARR value, then we can say that this project is desirable or justified. Similar to internal rate of return. Now suppose we consider one case. Suppose here we consider one case. So this some expenses is a 5,000. And this period is a 2 years. So this is a 1 year period. This is a 1 year first year period. This is another first year period. So total period is a 2 year. So first year is here, second year is here. So some expenses are 5,000. Very first initial gain is a 1,000. and after 2 years that gain is a 6,000. After 2 years this gain is at 6,000. So with this diagram, if we move further, so with this diagram if we move further, it is a 1,000 rupees in this project. If this represent a particular project, in this project rupees 1,000 you will get initially, 6,000 you will get after 2 years, and after 1 year there is some expenses 5,000. Now if if this 1,000 getting from this project, this diagram, this cash flow diagram represent a particular project. In this particular project, rupees 1,000 you will get, initially. So this 1,000 now company invested in another project. Suppose this is invested at particular rate 25%. Suppose this invested at particular interest rate 25%, MIRR value. This is a MIRR value. With this MIRR value, 25% company invested for a period of time. Suppose this is 2 year period of time. A company invested at this 1,000 initially get from this project, invested another project, reinvested another project having 2 year span with a MIRR value 25%. Then at this situation, so we can write for such condition, we write equation like this. For this consideration we write the equation like this. So 1,000 so 1,000 here, 1,000, so 1,000 we will get initially, and this 1,000 will invested, for 2 years, with interest rate 25%, for period of year 2, so 1,000 is invested for period of year 2 with interest rate 25%, and this F by P represents single payment compound amount. This we can now here 1,000 initially added. Now 6,000 you will get after the 2 years. 6,000 you will get after 2 years. And that should be equate. To the expenses. 5,000, and that we consider with some interest rate. Again it is a 5,000 for F by P factor with some interest rate I. And for period of year 1. Now here in this case we write equation for that particular case that we discussed in earlier, So here this is the case, 1,000 here, 1,000 first year, 6,000 after 2 years, and one more expense after first year is a 5,000. So for 5,000 that period is a 1 year. For 5,000 expense we consider this period is a 1 year, For 1,000 that period is a, for 1,000 amount that period is a 2 year. 6,000 this period is a 0, so this factor becomes 1, F by P factor becomes 1. Now with this equation, now in this equation 1,000 is invested for 2 years, 6,000 after 2 years, and this 5,000, now this 5,000 is a expense, For this 5,000, how much this interest rate how much this interest rate I should select. For this 5,000, how much interest rate I should select, so that this cash inflow, so that this cash reinvestment, this cash reinvestment equal to this cash dispersible, so equal to the expenses, so this cash expenses. So this particular interest rate is nothing but a external rate of return. This particular interest rate is nothing but a external rate of return. So in this case, this 1,000 is reinvested in another project for same period of time 2 years, for same period of time 2 years. Now this expenses, for the expenses, how much, for these expenses how much interest rate I should consider, for these expenses how much interest rate I should consider, so that this cash inflow, so that cash reinvestment, and this expenses, cash reinvestment and cash expenses should be equal. So that particular interest rate I is nothing but a external rate of return. That particular interest rate I is nothing but a external rate of return. So in this condition, this I gives a interest rate. I gives a interest rate, so that investment you can get as soon as possible. Investment you can get return as soon as possible. So this particular interest rate I is nothing but a external rate of return. This particular return I is nothing but a external rate of return. So that will represented in this example. So in this example, and in this example, this is similar to this previous discussed case. So in this example, a MIG welding machine is considered. MIG welding machine is proposed to increase the productivity of welding operation. The initial investment required is rupees 1,50,000, and the equipment have salvage value 25,000 at the end of the 6 year period of time. Salvage value is given at 25,000 after 6 year period of time. The increased productivity attributable will amount to 40,000 per year after deduction of the extra operating cost from the value of additional production. MRR is 20% per year. What is the machine's external rate of return? And is this purchase of this machine is acceptable? That are asking in this example. That is asking in this example. Now in this example, 1,50,000 is initially invested. 25,000 is a salvage value at the end of the 6 year. And some revenue after deduction of some expenses. Is 40,000. After deduction of some expenses is 40,000. With this and MRR for that particular company is a 20%. So at this condition, what will be the external rate of return? So as we discussed above previous project condition, with same approach we solve this example. So here 1,50,000 is here 1,50,000 consider as a for the 1,50,000 consider as a single payment compound amount F by P with some external interest rate, and that interest rate again with a for 6 year period of time. Again this we can equate. Now in previous discussed example, this cost is a 5,000. In here this cost is a 1,50,000. Here cost is a 1,50,000. 1,50,000 is a cost. So this will be represented like this. This will be represented like this. 1,50,000 cost. 1,50,000 cost. 40,000 you can get per year. 40,000 you can get per year after deduction of the extra operating cost. 40,000 you will get a per year. 40,000 you will get per year after deduction of the extra operating cost, and this is for per year. This is for first. This is first, second, third, fourth, fifth, and sixth. Fifth and sixth. After sixth year, there is some salvage value 25,000. There is some salvage value 25,000. And there is some salvage value 25,000. With this given condition, you have to find out interest rate I. With this given condition, you have to find out this interest rate I. Now, this in previous examples of interest rate, in previous example of that internal rate of return, we consider here this minus. We consider this investment, initial investment as a minus. Minus 1,50,000, like that. But here we consider in that particular case, this equal sign, we remove that equal sign, and that we write on a single side of the equation. In that case we put as a minus. But as here we equate the both the cash outflow and cash inflow, here we consider as is equal to. If you move this 1,50,000 on the right hand side, then it will be considered as a minus 1,50,000. That we observe in the internal rate of return or in previous calculations. So this is similar to our previously discussed project condition. Previously discussed project condition. Now here this 40,000 is a uniform series compound amount. This 40,000 is a uniform series compound amount for 6th year with some MIRR value 20%. Salvage value is 25,000 at the end of the 6th year. And this is a single payment compound amount. After the 6th year. With some external rate of return. Not with the external rate of return. So here 1,50,000 is initially invested. Initially invested. So this is a single payment. Compound amount with some external rate of return for a particular period of 6th year. This 40,000. Now this 40,000 is a revenue or receipt after first year with deduction of that particular expenses. That receipt we will get after some deduction of that particular expenses. This will be considered at each year. So this is the uniform series compound amount at rate 20% for period of year 6th year. And after the end of the 6th year, you will get 25,000. After the end of the 6th year, you will get 25,000. End of 6th year, you will get 25,000. Now, for this period is a 0. So this bracket becomes 1. So this bracket for this particular amount becomes as a 1. So put as a 25,000. Now simplify this equation. So this example is similar that we discussed in the previous project condition. Now after simplifying this equation, you will get some interest rate. You will get some interest rate IEE like this 18.82%. Now this F by P factor, which is equal to, this F by P factor is equal to 1 plus I ERR raised to period of time n, 1 plus I suffix ERR raised to factor 1. So put this now this IERR is unknown to us, but n is known to us 6th year. N is known to as a 6th year. This is a 1 first. This is 1. So with this simplify this. We simplify this equation. We will get this equation like this. This equation like this, and simplify this equation. And find out IERR is equal to 18.82%, which is less than MARR value, So this proposal is not desirable. If it is greater, if IERR is greater than MARR value, then we can say that it is desirable. But here this IERR value comes as a less than 20%. So it is not desirable. So we go through another numerical in next video, and then we move toward the next term as a payback period method.